The American retirement system is quietly being rewired from the inside out, and most people have absolutely no idea it's happening. We're talking about a multi-trillion-dollar shift in how your future income gets generated, stored, and yes, risked. Here's the setup. Annuity products now represent over 36% of total reserves in the US. Life and annuity insurance sector, up from 32% before the 2008 financial crisis. That might sound like a boring accounting footnote until you realize it means your retirement guarantee is increasingly backed by a financial architecture that looks nothing like it did a generation ago. So what actually caused this? When the Federal Reserve held interest rates near zero for over a decade, traditional insurers couldn't earn enough on safe government bonds to fund the promises they'd already made. It's like being a restaurant that promised all-you-can-eat steak, but suddenly the beef costs 4 times more. You either shrink the portions or find cheaper cuts. And the industry quietly chose the latter. Enter private equity and asset manager-backed insurers, the new power players, who looked at this yield crisis and saw a gold rush. These firms brought aggressive private credit portfolios. Think direct loans to mid-sized companies, complex structured products, anything that pays more than a treasury bill, and used them to offer annuity rates that made traditional carriers look like they were still using a flip phone. And for a while, it worked beautifully, or at least it looked like it did. Headlines celebrated the innovation. Retirees chased the higher guaranteed rates, and the PE-backed carriers gobbled up market share like it was a competitive sport. But here's where the sardonic plot twist enters. Approximately 1/3 of these annuity reserves are now sitting inside 95 companies that have lower credit ratings today than they did back in 2007. You read that, right? We took the lesson of the 2008 financial crisis and responded by quietly rebuilding a version of the same fragility, just with better branding. Now, credit ratings aren't a death sentence, and lower doesn't automatically mean dangerous, let's be fair here. But when you layer in the increasingly complex offshore and affiliated reinsurance structures these companies use to free up capital, you end up with a system that even seasoned analysts describe as difficult to fully see through. History gives us some grounding though, because we've danced near this edge before. The savings and loan crisis of the 1980s, the near collapse of executive life in the early 90s, the 2008 meltdown. Each time, the system was different. Each time, complexity was mistaken for sophistication. And each time, it was the everyday policyholder left holding the uncertainty. Here's the often missed piece of the puzzle though. State guarantee funds exist precisely for moments like this, providing a meaningful safety net for policyholders if an insurer fails. So the fear that your annuity evaporates overnight is largely a misconception. The structural guardrails are real, even if imperfect. The practical wisdom here is actually pretty straightforward. Diversification of carrier matters just as much as product selection. If you're building a retirement income floor using annuities, spreading across multiple, highly rated carriers isn't just prudent, it's the disciplined move, the move that lets process beat panic when the headlines eventually get scary. And the headlines will get complicated because interest rates are starting to come down, which is the engine that powered this entire annuity boom beginning to sputter. Lower rates mean carriers can't earn as much on new money, which means they face a brutal choice: sacrifice profit margins to stay competitive or quietly exit the market, leaving behind portfolios that still need to be managed for decades. The philosophical truth underneath all of this is that every financial product in existence is just a promise wrapped in paperwork. And the question you should always ask is who's making that promise and what are they holding to back it up? Discipline, sizing your exposure correctly, and choosing counterparties with clear, transparent balance sheets will always matter more than chasing the highest rate on any given Tuesday. The irony is that the very innovation designed to solve the yield problem of the last decade may be quietly planting the seeds of the next stress test, and the most prepared participants will be the ones who didn't get greedy, stayed diversified, and read the footnotes. Markets reward the patient and the process-driven, not the conviction-addicted, and that truth never goes out of style regardless of interest rate cycles. Whether you're navigating annuities, building real estate, cash flow, or just trying to make your money make sense, the framework is always the same. Understand what you own, who stands behind it, and what happens when the environment changes. And if you want help getting started, whether that's real estate investing, home contracting work, or finding the right lenders, check out our links in the description below.